Rezolve AI PLC, ticker RZLV, is currently trading at $2.89 per share, down about $0.06 or just over 2.03% in this morning's session, November 17th, 2025. And right away, we have a problem. The expectation, looking at that price, is that this is just another struggling, speculative, small-cap AI company bleeding out with the rest of the high-risk tech sector. It's a sub-$3 stock, and most investors, especially those just getting into online investing, would glance at it on their Robinhood app or SoFi Invest platform and swipe right past it. The reality, however, is that this sub-$3 company just over 1 month ago issued guidance for a minimum of $150 million in annual recurring revenue for 2025 and initiated a 2026 guidance for a $500 million ARR exit rate. This is the entire story. We are looking at one of the single biggest disconnects between a company's public forecast and its market valuation that exists on the open market today. The tension between what Rezolve says it is and what the market thinks it is staggering. This isn't just a stock, it's an argument, and a very expensive one at that. The general belief, the narrative that management is pushing hard, is that RZLV is the future of e-commerce. They call it Agentic Commerce. They have a Brain suite of products, Brain Commerce for multimodal discovery, letting you use text, voice, or images to find products, and Brain Checkout, a one-tap payment system that, interestingly, supports crypto-to-fiat transactions. The expectation is set. They are not just some back-office IT tool. They are a front-line, customer-facing platform, and they have the client list to prove it. H&M, Ferrero, Urban Outfitters, ASOS, Men's Warehouse. These are not small-time test clients. To top it off, they've been on a hiring spree, pulling in senior leadership from Apple, Google, and Microsoft. The narrative is pristine. It's built to attract investors who are watching the explosive returns of NVIDIA stock and are desperate to find the next one. They see 95.8% gross margins and H1 2025 revenue growth of 426% year over year. This sounds like the perfect investment. But the reality hits like a ton of bricks when you look at the chart. This stock is trading at $2.89. It's down from a 52-week high of over $8.45. Why? Because the market, in its entirety, does not believe that $150 million number. It's that simple. While the H1 2025 results did show a $6.3 million revenue figure, beating the $5.1 million consensus, there are other reports from the same period, specifically Q2, that show a revenue miss of 27.7%. This contradiction is at the heart of the doubt. Even more damaging, the company is facing a lawsuit filed by Gibbs Murrah, accusing it of overstating its revenue and the actual capabilities of its AI platform. This is the poison in the well. So, while one side of the investment help community points to the 426% growth, the other side points to a short seller-style lawsuit and says the numbers are imaginary. This is not a stock for a passive, intelligent portfolio or a set-it-and-forget-it Schwab Intelligent Portfolios account. This is a battleground stock reserved for high-risk, self-investing. Let's look at the movement today. This 2% dip is not the story. It's just noise. The volume is average. There is no company-specific news driving this. This is just the stock being pushed around by broader market sentiment and, most likely, the overhang of that lawsuit. The real action is happening behind the scenes in the institutional filings. When a stock is this controversial, you have to see what the smart money is doing. And the 13F filings from September 30th are fascinating. This is not just a retail stock traded on Robinhood stock trading platforms. The largest holder listed is Citadel Advisors, with a massive 21.3 million share position. BlackRock is in, with 7.8 million shares. Susquehanna and Jane Street Group are also significant holders. Now, the expectation is, wow, Citadel and BlackRock are in. I should be too. But the reality of modern investing sites is more complex. Many of these firms, particularly Citadel and Susquehanna, are not taking simple long-term directional bets like a Fidelity mutual fund would. They are market makers, quant funds, and arbitrage specialists. They could be holding the stock as part of a complex options strategy, as a hedge against a convertible bond, or simply trading the extreme volatility. Their presence confirms the stock is a player, but it doesn't confirm it's a good long-term investment. This is something that requires the sophisticated data analysis tools you'd find on an interactive broker's platform, not the simple charts on a Fidelity mobile app. So, what does Rezolve AI actually do? Let's be clear, it's a B2B SaaS company. A retailer like H&M pays Rezolve a subscription fee. In return, Rezolve's brain powers their mobile app's search function and their checkout process. The 95.8% gross margin is believable because this is pure software. Once it's built, scaling it is cheap. The 426% H1 revenue growth, while on a small base of $6.3 million, is what got everyone's attention. But the cash burn is the ticking clock. The company reported an adjusted EBITDA loss of $17.7 million. This was better than the $17.7 million loss analysts expected, but it's still a significant amount of cash being burned every quarter. This is not Apple stock, which generates tens of billions in free cash flow. This is a company that is spending heavily to acquire its growth. This is the classic SaaS model. Spend, spend, spend to get to that $150 million ARR and then hope to scale into profitability. The problem is that in a high interest rate environment, the market has no patience for profitability later. And that brings us to the lawsuit. If the claims are true, and the revenue or AI capabilities are overstated, then the entire growth narrative collapses. This is the binary risk. Comment below what you think is the real story with RZLV. Is the $150 million ARR guidance legitimate, or is the short seller lawsuit onto something? Looking forward, the picture for Rezolve AI is one of two extremes with very little middle ground. This is not a stock that is likely to just drift sideways. The first possible scenario, the bull case, is that the lawsuit is frivolous. It gets dismissed. The company then reports its Q4 2025 or Q1 2026 earnings and proves it is on track for that $150 million in ARR. If it posts a quarter showing, say, $25 million in actual recognized revenue, confirming the ARR ramp, this stock will not be at $2.89. A SaaS company with 95% margins and 100% plus growth with clients like H&M would in a normal market trade for at least 5 to 10 times its forward sales. That implies a valuation far, far higher than its current $700 million market cap. An individual brokerage account with a position in RZLV would see massive gains. The second scenario, the bear case, is much darker. The lawsuit gains traction. A court grants it class action status. Or perhaps worse, the company reports its next quarter and the numbers are a huge miss. They are forced to walk back that $150 million guidance. The contracted ARR turns out to have been optimistic pipeline. In this case, the stock's floor gives way. The institutional holders who were in for the arbitrage or the trade, like those using interactive brokers' trading algorithms, will be gone in a millisecond. The company will be left with a massive cash burn rate, a broken growth story, and a stock price too low to raise capital without catastrophic dilution. This is the danger. This is why it's not in Fidelity ETFs or managed portfolios. This is a high-stakes bet on management's credibility. It's a stock that could go to $10 or it could go to $1. This makes it a terrible candidate for a SoFi robo-advisor, but a fascinating target for a SoFi active investing account provided the investor understands the risk. So, as we watch RZLV churn around $2.89, down 2% on the day, we're not watching a stock. We are watching a verdict being decided in real time. The expectation set by management is that this is the next great e-commerce infrastructure play, a peer to the giants. They have the margins of NVIDIA stock and the client list of a mature enterprise. The reality, set by the market, is that this is a sub-$3 company with a credibility problem, a lawsuit, and a high cash burn rate. The drop today is irrelevant. The only thing that matters is who is right. Is the $150 million ARR guidance real, or is it a fantasy? The market has placed its bet firmly on fantasy. The company and its major institutional backers are betting on reality. This is a